Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada, just right outside of Toronto. My mission is to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is about housing, and particularly it's about a new anti-flipping rule that's imposed by the federal government, which was announced earlier this year. Now, I don't know if you are aware, since March of 2015, the Canadian government have launched, particularly the CRA, have launched an audit-focused initiative in the housing market, in the real estate industry. It recovered over $1.1 billion from Ontario audit alone, and another $1.1 billion from auditing BC taxpayers alone. So that does not account for all the other provinces, the audit initiatives launched in the other provinces. So they've recovered a lot. And one of the areas that they are focusing on is flipping, properties flipping. And earlier this year, they also announced a bunch of rules changing, better defining what consider flipping. And today we're going to dive deeper into this new anti-flipping rule. But before I get started, make sure you give us a thumbs up if you like this video and you find it useful. And if you like to stay on top of our latest tax tips, make sure that you hit the subscribe button below so you can stay notified the moment our video get released. Now with that, let's get started. So with this anti-flipping rule, basically what it means is that you as the taxpayer, if you sell a property within 365 days after you own the property, you are automatically deemed to be flipping the property. When you're flipping the property, every transaction, all the profit that you make is to be considered business income. 100% of it is taxable. Now let's just use an example to explain. If you were to sell a property and the closing happened after December 31st, 2022, so starting from January 1st, 2023 onwards, if you sell a property and the closing day happened there at that time, and you've only owned that property for under 365 days. And if you actually made money, assuming you made money, if you made money, that profit is not considered capital gain. It's considered 100% taxable. And 100% taxable really means that the entire profit that you make will be added to your income. If you own the property in your personal name, so then 100% of the profit after deducting all the eligible expenses would then be added to your income and being taxed at the marginal tax rate that your income would be subject to. If you own that property in a corporation, chances are, and assuming you are a Canadian resident, and assuming that your corporation qualify, chances are in Ontario, you're only subject to 12.2% tax. In personal side, you could be subject to as high as 53.5% tax. Now, why does it matter? How does this rule apply and how is it different from the old rules? Well, as it turns out, there isn't a whole lot of differences, except that they now call out the 365-day restriction, ownership duration. Now, let's step back and look at how taxes would apply under normal circumstances before this new rule came out. Now, so before the new rule came out, let's say you sell a property. This property, it could be your primary residence, it could be anything. It could be a rental property. It is a residential property and you sell this property. Now, assuming you make a profit, what's going to happen is that it could be taxed either as capital in nature, the transaction could be considered capital in nature, or the transaction can be considered business in nature, or it's deemed to be something called a venture in the nature of trade. So either way, there are only two ways to account for this type of transaction. A sale of property, it could be considered business or it could be considered capital in nature. Now, when it is considered business, what it means is that 100% of the profit that you make is taxable. So 100% of the profit is taxable. Now, so if you make $100,000, then the entire $100,000 from your sale is taxable, added to your income like I mentioned before. And if you own the property in your personal name, then that $100,000 could subject to as high as 53.5% personal income tax rate in Ontario. Now, If it is in the corporation, it could be subject to as low as 12.2%. So as you can see, if you plan it out, you could have substantial tax deferral if you own the property and you make the profit within your corporation. On the other hand, if you sell the property and the transaction itself is considered capital in nature, then you need to look at the criteria. Are you living in the property? Are you using it as your primary residence? If you're using it as your primary residence for the entire duration of ownership, so you live there forever, live there and use it as your primary residence for duration of the ownership, then there is no gain, no tax at all. But if it is your primary residence, you only live in there during a portion of the time, then there could be some tax, but we don't know how much. You have to calculate it. But the amount of profit that you make will be prorated profit based on the year of ownership, and only 50% of that is taxable because it's capital in nature. So anytime it is capital in nature, it's only capital gain. So capital gain is only 50% taxable. Now, if let's say you make $100,000, the same $100,000 profit, if you live in that property for the entire duration and you use it as your primary residence, no tax. The $100,000 profit that you make, no tax. Now here, if you use it as for a number of years as your primary residence, but not the entire duration, only the years that you are using it as your primary residence, you would be able to get exempted from tax. And the year that you use it as your rental, you will have to pay tax for it. So, but then the profit is then prorated for the duration that you use it as your primary residence, and then that profit is then multiplied by 50%, and only that amount is being added to your taxable income. If it is in your personal name, again, subject to up to 53.5% tax rate, but it's only 50% of the gain. Now, let's say you always use it as your rental. In that case, if you always use the property as your rental property, the profit from the transaction, the sale of the property, would be considered capital gain. So capital gain in Canada is only 50% taxable. So if I take that 50%, using my example, the $100,000 profit, only $50,000 is taxable. And only the $50,000 is subject to, if you own it in your personal name, subject to 53.5%. If you own it in the corporation, you are subject to 50% tax. But only $50,000 is subject to the 50% tax. And out of the 50% tax, 30% could be refundable. It's a refundable dividend regime. Okay, you may then ask, like, how do you determine whether the sale of the property is considered business or considered capital in nature? What are the criteria, selection criteria that's imposed by CRA? Well, the Income Tax Act doesn't really have those criteria. It is the previous court cases that established a bunch of criteria, and that is 12 criteria to be exact. So here are the examples, the whole list of the criteria. The first one is taxpayer's intention. What is the taxpayer's intention? Of course, if I were to buy a primary residence, say I buy a primary residence, and my intention is to live in the property for a long time, and I move my family into the primary residence, I am ordinarily inhabiting that particular property, that's my intention. But you cannot just state that your intention is to move in there. You actually need to have surrounding evidence to support that you are moving into the particular property. So in my particular example, if I were to purchase a property and my intention is to move into the property, I cannot simply, as a taxpayer, I cannot simply tell CRA, hey, my intention is to move in without providing evidence. What do you mean by your intention is to move in? Do you have moving expenses that show that you moved in, move all your furniture in? Do you have any new furniture moving into the property? Do you have registration with your kids' school? Those are the evidence to prove your intention. So make sure that you actually provide those corroborative evidence to support your intention claim. The second criteria is the feasibility of your intention. Now, using my example, I made the comment that I intended to move into the property. If the property is in a condo and it's a one-bedroom condo, and I have a family of 4 people, it's not feasible for me to move my entire family to fit into that one-bedroom condo, and therefore that intention is not possible. And therefore, CRA also look at whether you claim whatever you claim your feasibility, your claim your intention is, it has to be something feasible and reasonable. Now, they also look at the geographical location. That's the third criteria. Geographical location and zone use of the real estate required. So if I said I buy a commercial property as my primary residence, and I'm going to occupy it as my primary residence, and the zone use of the property is really only for office space. We're in an office space in Oakville, and if I tell CRA that I intend to buy this property for my personal use and I'm going to move in, the zone use doesn't allow that. So that is also not possible. Geographical location, they also look at that. I say that I'm moving into an island cottage that could only be accessible by the boat, and I'm going to use it as my primary residence, but there is no way for me to commute between the property and the closest port, and it may not be feasible. So depending on the geographical location as well. The fourth criteria is the extent to which intention carried out by the taxpayer. So remember I mentioned earlier, if you are, I intended to move into the primary residence, and I don't have any evidence, I don't have any action taken to accomplish that intention, that would not work. So using an example, if I were to move into if I intended to use a property as my primary residence, I would have moved into the property. I would have done all these work. I would have hired a mover. I would have hired an interior designer to maybe remodel the home. How much work have you put into this particular purchase to help you achieve a certain intention, your intention? The sixth criteria is the nature of the business professional calling or trade of the taxpayer and associates. So CRA look at what you do for a living. If you're a real estate agent, chances are they're going to look at the transaction more closely, the sale of the property more closely, and see if you are really operating it as a business because you have professional knowledge. I'm a real estate accountant. They may also take that into consideration and saying, hey, like you are in the business of doing books for real estate investors. So you must also know a lot more about this real estate market. And you may be in the business just to take advantage of the market. So they would look at that and make such an argument. But if you are a teacher, for example, or a stay-home mom or stay-home dad, you have way less knowledge compared to an average real estate agent, and therefore it is less likely for the court to decide conclude that you're operating a business. The sale of the property would be considered business. And how much money, they also look at how much money you've borrowed to finance the acquisition and the terms of financing as well. So using an example, if you are intending to flip a property, so essentially you're buying and then you don't rent it out, you essentially renovating it up, and then you turn around to sell the property, typically, you're running it as a business, you buy the property and then you sell a property in a short period of time. It's less likely for a flipper to commit to longer term financing. So 5-year fix, that's very unlikely unless they are forced to do it. The shorter the mortgage term are, or the private, if you use more private money, those are more characteristics that's pointing the transaction to business. So 100% of the profit would be considered business, and therefore it would be 100% taxable. Now, on the other hand, if you are buying a primary residence or a longer term rental property, chances are you would be committing to a longer period of mortgage, a 5-year term fix or 5-year variable, and it helps you, the term of the financing also help you to prove that you are on the capital side, your transaction is on the capital side. Next criteria is how long you have owned the property. Well, the length of the time of ownership matters. So the shorter the period, then the more likely it is considered business or something called a venture in the nature of trade. Essentially, you take the opportunity to flip it to get some quick profit. That's what it really means. This is really hard for me to understand too. A venture in the nature of trade, I can't pronounce it. I could barely pronounce it, but this is a term that CRA and the court use in Income Tax Act. Now, existence of other partners who share interest in the real estate. So if you partner up, you do joint venture partnership, and you invest through joint venture partner, but you're the passive investor. You don't do anything. You just put the money into the deal. Would your income be considered passive or active? Because you are literally the passive investor. So from your point of view, you're really doing everything passive. But the reality is that they don't really look at it. They look at what the joint venture does. So if the joint venture invests in the property that they renovated up and they turn around and sell it without renting it out and sell it within 365 days, chances are that particular property is more likely to be considered on the business and a venture in the nature of trade side. So 100% of it is taxable. 100% of the profit is taxable. And therefore, it's subject to 53.5% or 12.2% depending on the ownership structure. If you, on the other hand, if you are the sweat equity partner and the deal is really on a long-term rental and you have an executed plan, your agreement signed, you reevaluate that relationship, the joint venture investment relationship in the next 5 years, which happen all the time. I see it in the joint venture agreement. Then chances are that particular transaction is considered capital in nature, and the profit that you make from the sale of the property will likely be considered capital gain. So again, if you cooperate with someone else, you partner up with someone else, what do that other your investment partner do? If your investment partner is a full-time real estate investor, they market themselves as full-time real estate investor, chances are CRA is going to say, hey, you have a professional on your team. So because you have a professional, therefore, it's more likely the transaction is considered business side rather than capital in nature side. And also factors that motivate the sale of the real estate, they consider that as well. And the last one is evidence that the taxpayer had dealt with extensively in real estate, which we mentioned before. If you are a full-time real estate investor or you always market yourself and you market number of deals that you do on an annual basis, that's going to be a red flag for CRA, and the transaction could then become a business in or a venture in the nature of trade, because you market yourself as such. Now, we talk about 12 criteria to determine the transaction, whether a sale of the property is considered capital in nature or business or in the business or a venture in the nature of trade. And the reality is there is no particular criteria that would outweigh the other criteria. They look at all these criteria as a whole and then make a conclusion out of it. So sometimes you'll see transaction or court cases that would be going with for the taxpayer, which is capital nature transaction. Sometimes you'll see that it is going for CRA and therefore it's being treated as business. So it really goes back to the case fact, and there is no black and white answer. And these are the old rules. So now the new rule came in, which is the Budget 2022 announcement. The new rule is coming in January 1st, 2023. And what the new rule is saying is that these all still apply. All the criteria that I mentioned, the 12 criteria that I mentioned, would still apply. But there is one more step. Okay, so this Budget 2022 essentially added one more step into our decision tree that we just shared with you. They added this 365 days rule. If you dispose a property, a residential property, within 365 days and you make a profit, a special rule applies. Essentially, that profit is immediately treated, except if you meet the exception criteria, which we will go through in a little bit. If you don't meet any of the exception specified in the Income Tax Act, then 100% of the profit that you made would be taxable. So it's automatic. if you sell the property within 365 days, and even assuming you lived in the property before, unless there is some criteria that you've met before in the past. So if you live in the property and you're selling within 365 days, chances are it's not a smart idea. You wanted to stay past the 365 days as a little bit longer to make sure that you don't get caught in this 365 days rule. Now, what are the exception criteria that could allow you to sell the property within 365 days and potentially make a profit and not being taxed as the business income? Here are some examples of the criteria, the exclusion. The first one is the death of the taxpayer. Or a person related to the taxpayer. If you have someone that's related to you that passed away that forced you to sell the property, that's allowed. One or more person related to the taxpayer joining the taxpayer's household. So meaning you get married or you have change of certain circumstances, maybe you have a kid, breakdown of the marriage or common law partner. And then a threat to personal safety is also one of the exclusion. Taxpayer is or a related person suffering from serious illness or disability, an eligible relocation of the taxpayer or the taxpayer's spouse to a new residence in Canada, a new work location as a result of new work location. Termination, involuntary termination of your employment, if you go bankrupt, or there is a destruction or expropriation of the property. Those are the exceptions allowed to be applied to kick you out of this 365 days rule. Now, so let's just go back to the new rule to revisit this new rule. The decision tree is slightly different from before. Now you have a sale of property. You have to first decide when you sell it. And remember, this new rule is applicable to any sales that happen after starting in January 1st, 2023. Now, if you have a sale of the property, it's less than 365 days and you make a profit, assuming you make a profit. Then you have to go through the list of exceptions. If none of the exclusion apply to you, then 100% of your profit is taxable. And if it is included, if it is only in your personal name, then 53.5% tax would be applicable. So if the exclusion applies to your particular situation, chances are the transaction is more on the capital in nature side, because if you look at all the exclusion, you're involuntarily required to dispose the property. And if the exclusion applies, then chances are it's capital in nature. Then you have to go through the decision tree to decide, okay, well, did you live there before? If you live there, then you may get exempted to pay tax. And if you didn't live there before, it's still considered 50% taxable. So the profit that you make is considered capital gain, and only 50% of that would be taxable capital gain, and therefore you add it to your personal income tax. And that's how these whole calculation comes in. Now, if you own the property for 365 days, more than 365 days, or you actually incur a loss. So this rule, 365 days rule, do not apply to situation where you incur a loss. Now, so if this is the case, you incur a loss and you own it less than 365 days rule, then it's still the old rules that apply. The old rules is the 12 criteria that I mentioned before. You go through those 12 criteria to decide whether the transaction is capital in nature or business or adventure in the nature of trade. And again, if it is determined that you are flipping property or operating that as a business, then 100% of the profit would be taxable. And if it is determined that it is capital in nature, then you can apply whether you live in the property or not, and you can apply some of or all of the primary residence exemption to it, or you can, it is a long-term rental, long-term investment, or personal use residence, then chances are the profit that you make would be 50% taxable. Now, it is worthwhile to mention when you incur a loss, it also matters how you determine whether the business, whether the transaction is considered business or a venture in the nature of trade. The reason is because the main reason is because if it is a business loss, 100% is recorded, and you can apply it against employment income, all sources of income, to offset and reduce dollar for dollar in terms of income. So it's kind of like an RSP deduction, except you incur a loss, and the loss is offsetting against your income, and taxes is then reduced by based on your marginal tax rate multiplied by the losses incurred. Now, on the other hand, if it is capital in nature, so it's an investment essentially. If it is capital in nature, the losses that you incur is only 50% as well, because the gain that you make is 50% taxable. And the losses that you incur would also be 50%. And the losses can only, it's called capital loss, and you can only apply the capital loss against capital gain in general. So if you don't have any capital gain, that particular year you have lots and lots and lots of losses, then that losses can be carried forward forever until you incur a gain, and it could then be applied against the capital gain in your future. Or you have capital losses incurred in the past, then you could apply the capital losses that you incur back 3 years. So it makes a difference when it's a loss. It makes a difference when it is a gain. The biggest difference is that losses, it's way better to be in the business category. If it is a gain, it's way better to be in the capital category, because then you get taxed less. But unfortunately, it's being set by the 12 criteria. CLA draw their conclusion based on your behavior, your history, and pattern of behavior as well. It's not an easy one-size-fits-all answer. What they had done with the new rule is by using the 365 days rule to really slash everyone into that bucket, that size bucket, and force everybody who trade their houses, any of their property, within 365 days to have 100%, to force them to pay taxes on 100% of the profit that you make. So that basically concludes the detailed explanation of our anti-property flipping rule. Now that we've covered the details of the anti-housing flipping rule, do you have any questions about flipping your property? Or are you planning to sell a property in the upcoming years and you're concerned about this neo crazy rules that we just explained? If so, please leave it in the comment, any questions you have in the comment section below, and I'll take my time to respond to you one by one. Now, if you find this video useful, or you have someone in your life that could use this video and get a better understanding of how this rule works, make sure you share this video with that person. Give us a thumbs up if you find it useful, and subscribe to our channel. Until next time, thanks for watching.